Good morning/afternoon, investors. Welcome back to the channel. Today is Tuesday, December 23rd, 2025, and Wall Street is trying to hold on to a Santa rally despite some flashing red signals on the macro dashboard. We are seeing a fascinating divergence today. The Dow Jones and S&P 500 are pushing record highs, yet oil is collapsing, and Bitcoin is showing signs of fatigue. Is this the final push of 2025? Or are we setting up for a January hangover? In this detailed report, we're breaking down the overnight action from Asia to Europe, the key US GDP numbers just released, why MicroStrategy is suddenly sitting on cash, and the political comments shaking up the trade landscape. Let's dive into the numbers. First, let's look at where the markets stand as of the last close and today's open. The bulls are definitely in charge of equities, but volatility is creeping into commodities. United States, Dow Jones Industrial Average, closed yesterday at 48,362.68, up 0.47%. The blue chips are leading the charge, seemingly immune to the tariff noise. S&P 500 finished at 6,878.49, gaining 0.64%. We are knocking on the door of the psychological 6,900 level. Nasdaq Composite, up 0.52% to close at 23,428.83. Tech is participating, but it's not the explosive leadership we saw earlier in the year. Russell 2000, the standout performer yesterday, surging 1.16% to 2,558.78. Domestic-focused stocks are betting heavily on the U.S. exceptionalism theme. VIX cooling off significantly, down over 5% to 14.08. The fear premium has evaporated for now. Europe, FTSE 100, trading flat to slightly down at 9,865, struggling to break the 10K barrier due to energy sector weakness. DAX, hovering around 24,290, largely unchanged. CAC 40, under pressure, trading near 8,102. Asia Pacific, Nikkei 225, eked out a small gain of 0.06% to 50,431, capped by sudden volatility in the yen. Hang Seng dipped 0.11% to 25,774, continuing to be the lagger as trade war concerns weigh heavily on sentiment. Now let's unpack the macro data that is driving these moves. The headline story today is the U.S. economy. It's slowing, but not stalling. 1. Q3 GDP final estimate. We just got the final read on Q3 GDP. It came in at 1.9%, slightly missing the expectation of 2.1%. This confirms that the U.S. economy cooled down in the back half of 2025. While 1.9% isn't a recession, it shows that high rates and the initial bite of new tariffs are starting to drag on growth. 2. Durable goods orders. October durable goods orders rose just 0.2%, missing the 0.5% forecast. Business spending is hesitant. Why? Because CEOs are still waiting for clarity on the full implementation of the Trade War 2.0 policies. 3. The data void and government shutdown legacy. Here is a crucial detail impacting algorithms today. Analysts are warning of a data void. The recent prolonged government shutdown has disrupted the collection of October and November data, specifically the PCE inflation readings. The Federal Reserve is arguably flying blind into 2026, which explains why the VIX is low. The market assumes the Fed will cut rates just to be safe, but we lack the hard data to confirm inflation is dead. 4. Japan's yield spike. Over in Japan, we are seeing a massive move in bonds. The 30-year JGB yield hit record highs. The Bank of Japan has signaled a potential rate hike this week to defend the yen, which has been weakening suddenly. This is pulling liquidity out of global bond markets and is a key risk to watch. The most violent moves right now aren't in stocks. They are in commodities. We are witnessing a historic divergence between oil and gold. Oil is crashing. Brent is trading around $61.93. Down another 0.23% today. The cause? It's a supply glut. U.S. production is at record highs, and we have reports that Saudi Arabia is struggling to maintain price floors. The impact? This is great for the consumer, but it is hammering energy stocks like Shell and BP in London. There are also headlines about America's risky bet on hydrocarbons potentially backfiring as global demand softens. Gold. On the flip side, look at gold. It is trading at a staggering $4,488 per ounce, up nearly 1% overnight. The narrative: why is gold rallying if the stock market is at all-time highs? It's a hedge against fiscal chaos. Investors are buying stocks for growth, but buying gold because they are terrified of the ballooning U.S. debt and the geopolitical friction we're about to discuss. Politics is front and center today. The Trump trade is evolving into the Trump tension. 1. Farm aid backlash. We have reports this morning that U.S. farmer associations are pushing back against the administration. They are saying the proposed $12 billion aid package is not enough to undo the damage from retaliatory tariffs. This is politically sensitive for the White House and suggests that the trade war costs are hitting home faster than anticipated. 2. U.S. versus China. China has just announced new tariffs of up to 42.7% on EU dairy products. This is a direct retaliation to Western sanctions. It's creating a fragmented trade environment. Quote of the day: we heard from a Japanese official warning about the yen's sudden weakness, hinting that coordinated intervention might be needed. This puts the US dollar in the spotlight. If the US administration wants a weaker dollar for exports, they are getting the opposite right now. 3. UK Fiscal Watch. In the UK, Chancellor Rachel Reeves has set an early March date for the spring statement. The UK economy is under pressure from the Brexit drag and new global protectionism. The FTSE is underperforming global peers as investors wait to see if the UK can navigate this squeezed middle ground. Let's look at the companies making headlines. 1. Tesla versus BYD. Tesla is up 1.56% in the US, riding the general market wave. However, the macro story is worrying. Data out of Europe shows Tesla sales falling again while Chinese rival BYD surges. The competition in the EV space is brutal, and Tesla's premium valuation is relying heavily on its AI promises rather than car sales volume right now. 2. Nvidia. Nvidia is up 1.49%, continuing to be the backbone of the S&P 500. There are no signs of the AI trade slowing down, despite the broader economic cooling. 3. Ryanair, a big blow for the airline. Ryanair has been fined €256 million by Italy's competition authority. This is hitting their stock in European trading and serves as a reminder that EU regulators are getting aggressive with large corporations. 4. M&A news. Paramount is in the news with Larry Ellison reportedly giving a personal guarantee to push through the takeover of Warner Brothers Discovery assets. Media consolidation is heating up as legacy players try to survive the streaming wars. Finally, we have to talk about crypto. If you are a Bitcoin investor, pay close attention to what MicroStrategy is doing. Bitcoin is trading at $87,815, down about 1.1% in the last 24 hours. The chart: BTC rallied to $90,000 earlier in the week, but failed to hold it. The price action is looking heavy as we head into the holiday liquidity drain. The narrative: traders are risk-averse ahead of the US PCE data. The buy the rumor, sell the news dynamic is in full effect. The Michael Saylor signal. Here is the major news. MicroStrategy, the largest corporate holder of Bitcoin, has reportedly paused its purchases and increased its cash reserves in the last week. Analysis. For years, Saylor has been the relentless buyer. If MicroStrategy is building a cash pile right now, it signals they might expect a better entry price, perhaps a dip into the low $80 KS or high $70 KS. This is making retail investors nervous. Regulatory context. We are also seeing lingering effects from the Trump pardons headlines, specifically regarding Binance founder. While the market initially cheered the pro-crypto stance of the administration, the institutional money is now waiting for actual legislative bills, not just executive gestures. So, what is the takeaway for your portfolio? The stock market is telling you everything is fine. Indices are at record highs. But the bond market, the commodity market, and the corporate insiders are telling a story of caution. For the next 24 hours, watch these three things. Oil prices. If Brent breaks below $60, expect energy stocks to drag the whole market down. The yen. Any intervention by the Bank of Japan could cause a flash crash in the dollar, impacting crypto and tech stocks. Volume. It's December 23rd. Volume will vanish by lunchtime. Be careful of fake moves on low liquidity. Next step for you. If you want to know exactly which defensive stocks hedge funds are buying to protect against this potential Q1 correction, drop a comment below saying defense, and I'll pin a list of the top 3 sectors holding up best in this divergence. Thanks for watching. Hit that like button if you appreciate the detailed data, and I'll see you tomorrow for the Christmas Eve close. Let's stay green.